Have you seen a currency fall so far that $1 can buy nearly an entire economy? That is the situation with the Japanese yen, at its weakest in 4 decades. This isn't merely numbers on a chart. The fall affects millions, from travelers to multinational corporations. So, what does it look like in everyday life? Imagine $1 buying roughly 160 yen today. In 2012, it bought about 80 yen. Put simply, the same money now buys twice as much in Japan as 12 years ago. The dream of tasting I-5 Wagyu or staying in a five-star hotel is no longer out of reach for many. In the 80s, land in Ginza, Tokyo's central business district, reached about $139,000 per square foot. A modest Ginza office could cost as much as all the land in central San Francisco. Yet today, land prices in Japan have since fallen by more than 80%. Imagine a Moscow apartment that in the 90s was worth an entire block in central New York. Today, it would fetch only enough for roughly half of a similar home in a provincial town. That is how it felt when property, once a symbol of wealth, collapsed to extreme lows. The Imperial Palace in Tokyo was once the most expensive real estate on Earth, with a 1989 estimate of $852 billion, exceeding the California market. Now it stands as a cultural monument, unable to reflect the country's former power. It is as if Big Ben in London had dropped to the price of a village hall, while tourism revenue cannot cover even half of its upkeep. The yen's weakness is not just a set of figures. It is a real drama spanning billions, thousands of firms, and the future of a generation in Japan. In 2024, visitors to Japan rose to 900,000 in 5 months, up 17% from the same period the year before. The cheaper yen has made travel remarkably affordable. For example, a U.S. traveler who in 2019 could only afford a casual lunch can now enjoy a sushi feast with the priciest tuna or dine at the most expensive restaurant for the same money. Accommodation and rental costs have fallen enough that many visitors extend their stays, with some planning to return several times a year. Not only travelers benefit from the yen's decline, luxury brands in Japan like Louis Vuitton and Gucci have gained as well. With the currency in flux, many goods inside the country have fallen in price, drawing shoppers from around the globe. You may wonder why today Japan feels cheap to foreigners while many Japanese are puzzled by it all. The yen's drop has touched nearly everyone. For visitors, it becomes a treasure trove. Upscale meals for little and brand-name items priced like ordinary jackets back home. And what of business? Multinational firms are snapping up Japanese technology and equipment because it costs far less than elsewhere. Yet locals are not thrilled. Prices for imports, coffee, fruit, and other staples are rising quickly while wages barely budge. Imagine saving for years, only to be able to buy less each month. This is the daily reality for millions today. And this is not merely a domestic issue. A cheap yen makes Japanese goods more competitive abroad, which helps the economy but hurts foreign producers. Cars and electronics can be sold cheaper by Japanese firms, pushing European and American competitors aside. So what happens on the world market if this trend persists, and why did a once strong economy weaken so quickly? In the 1980s, Japan stood at the summit of power, seeming to outpace the United States. The economy came to symbolize high-tech, reliable cars and solid financial stability, yet that success foretold collapse. The 1980s saw Japan house the world's largest stock market, with the total value of its companies accounting for about half of global capitalization. over $4 trillion. By comparison, the American market was about half that size. It felt as if a few firms like Apple and Amazon could dwarf all European companies combined. Yet this sweep touched nearly all major Japanese firms. The trouble lay in profits earned from land and securities rather than goods. Speculation swept in, and IPOs became so popular that people bought shares without knowing what the companies did. The first-day returns averaged about 32%, fueling the illusion that wealth could be made effortlessly. But the economy rested on credit and speculation, a house of cards that shone until prices stopped rising. Have you ever wondered how a single international agreement could upend a nation's entire economy? In the mid-80s, Japan stood at the height of prosperity, with cars, electronics, and other Japanese goods in high demand. Then, in 1985, the Plaza Accord arrived, aiming to push the yen higher. At first, a stronger currency seemed a sign of strength, but a crucial caveat followed. The more expensive the currency, the costlier the exports. Japanese cars and electronics, once affordable abroad, grew pricier and less competitive. Exports fell and corporate profit sagged, prompting authorities to act. They cut interest rates, making credit cheaper and stoking a flood of speculation. When money is almost free, people rush to buy stocks, land, and property, chasing quick gains. Thus began one of history's largest speculative booms, and Japan rose to global prominence on the back of cheap money. Yet behind that ascent lay a dangerous dependence on speculation and easy credit. As the bubble swelled, it looked unstoppable, but every bubble bursts in time. By the early 90s, the real estate market in major cities fell by 84%, destroying trillions in wealth. Millions of families lost investments, and many homes ended up worth less than the loans they carried. Imagine buying an apartment for $500,000, only to see its value drop to $80,000 while the loan remained due. This shock shattered a society accustomed to rising property prices. The crisis gave birth to a legion of zombie companies, overloaded with debt, unable to grow yet kept afloat by subsidies. Meanwhile, the stock market collapsed by 80%, and by 2003 its capitalization was smaller than in the 80s. For thousands who had invested, the losses were total. Why did this happen? A primary reason was excessive regulation and weak oversight of financial institutions. Banks lent freely, turning a blind eye to risk. People borrowed to buy assets hoping prices would rise, and when the market collapsed, few were prepared for the consequences. Yet the Japanese economy endured a slow, painful recovery that stretched for decades. It might seem that the yen's decline is a problem for Japan alone, but economic troubles rarely stay local. The yen is one of the world's leading currencies, and its fall echoes across continents. So how does that affect us here? The dip in the yen ultimately touches ordinary lives in surprising ways. The situation is more than news. Yen weakness can make Japan suddenly attractive to tourists and foreign investors. For many, the economy feels devalued when money sits in stronger currencies. And the impact travels beyond borders because Japan is a major player in technology and the automotive industry. A cheaper yen makes Japanese goods cheaper on world markets, potentially squeezing producers elsewhere. That can pressure automakers abroad, as Toyota and Honda can price cars more competitively, challenging American and European makers. Japan's bond markets become less appealing as yields shrink and rates hover near zero or even slide below zero. If you owned Japanese bonds when rates were negative, you could lose money not only from the tiny yields but also from currency moves. It is like holding a security whose profits are eaten away by inflation. For ordinary people, import prices may rise as Japanese firms offset losses from a weakening yen by higher prices on goods like cars and electronics. So the yen's decline is not merely a local issue, but a signal of potential global economic strain. How can people prepare and safeguard themselves from such shocks? Share your thoughts in the comments. Thank you for reading.